Hello, welcome. Thank you for joining us today. We're broadcasting live from Park City, Utah, where I am, which I tend to be lately. So
I'm jealous, Arthur.
yeah, it just snowed 6 inches here the last 2 days, and there was no snow 3 days ago. So John is here broadcasting from New York City. Super happy. Big shout out to Ilka for referring you. She's a star. We're super crazy about Ilka. And thank you for that, Ilka. If you're on, I'll thank you again another time if you're not. So thank you all for being here today. As you know, we can't hear or see you, but we welcome questions in the chat box in the Q&A. And please post them as they come to mind. We have a lot of people coming on today, but we'll get to as many as possible. Don't be shy, post them in the chat box or the Q&A. Thank you all, Family Office Insights members, for being with us through the pandemic and webinars and switching from in-person stuffs, and really appreciate your participation in these. We are going to make sure that, excuse me, John is in touch with you directly after the webinar, and so you can feel free to discuss with him directly an investment in the fund, which is what the topic is today. Also, we're going to be recording this and posting it on the Family Office Insights YouTube channel. So if you care to visit and review parts of it, or if there's anybody in your world that would benefit from hearing what you hear today, you're welcome to share that with them as well. So with that, John, welcome. Thank you for being here. Take it away.
Great. Yeah, thanks, Arthur, and thanks to the folks at Family Office Insights for hosting us, and most importantly, thanks to all of you for joining us today and sharing some of your time. As Arthur said, I'm John Lykouretzos, the CEO of FocusGrowth. I have 15 or 20 minutes of prepared introductory remarks, and then I'd be happy to dive in and answer questions. But I want to start with just 3 primary takeaways for you. The first is the cannabis market is huge. It's growing rapidly, but it's non-institutional and incredibly complex. I think there are enormous opportunities for excess returns, but the market is very, very risky. And I'm sure many of you on the call have had either negative experiences or know those who've had negative experiences through the 2016, 17, 18, 19 period, the green rush, as we call it, and then the collapse of the cannabis market. So it's risky, but there's real opportunity. The second thing in terms of a takeaway is FocusGrowth is a curated team of professional investors with significant experience in private and public debt and equity, combined with hands-on experience starting and operating multi-state cannabis operations. So I think it's a really important differentiator in terms of navigating this complex and risky environment. And a key thing to remember is the FocusGrowth team is the largest investor in the FocusGrowth funds with over $30 million of committed capital. And the third thing I'd say is our fund, FGCP2, is an advantage structure that allows maximum flexibility in deploying capital and allows us to be the partner of choice for cannabis businesses and to generate the best risk-adjusted returns for investors. So just keep those 3 things in mind. I'm going to run through a little bit about our background of the team, the timeline, and then we'll go through a couple of examples in the existing portfolio. So let me just share the screen here. Great. So here's the FocusGrowth team or leadership team. I'll just start with my background. John Lykouretzos here. Started my career in banking at Goldman back in '95. Did banking and private equity, and then in 1998 started a career in the hedge fund industry. First working for Julian Robertson at Tiger Management. 1998 and 99, and then I went to a startup fund called Viking Global Investors, and I was at Viking pre-launched as an analyst and a portfolio manager for about 3.5 years. I left Viking in 2003 and started Hoplite Capital Management. It's a fund I launched at July 1st of 2003 with $88 million. I ran Hoplite for 16 years. Assets peaked just under $4 billion. And I made the decision in 2019 to return capital. Public equity markets were certainly very competitive, and we weren't generating the returns that, as our largest investor, that I was happy with. So I made a decision to return capital. I have an old close friend and college classmate named Dave Feuerstein. Here, Dave had a career as a litigator, working first for David Boies, and then as a partner at a law firm here in New York called Herrick. And in 2016, Dave and some partners, including Brian Meltzer, decided to start a New York-based cannabis-focused law firm. That firm, Feuerstein Kulik, started in March of 2016 and had grown to 12 people by 2019 when I decided to return capital from Hoplite. Dave and his team were outgrowing their space. I asked them to move into my offices here at 810 7th Avenue to be my tenants and to teach me about cannabis, because I'd started a family office and was looking at other areas to invest in. They moved in Labor Day of 2019, and my office quickly became a hotbed of cannabis activity, of companies coming in, looking for corporate finance advice, looking for application assistance, and of course, looking for capital. After 22 years, I had left the most liquid, transparent, competitive markets in the world, the global equity markets, and cannabis was the other end of the spectrum. And I said earlier, it's a frontier market, it's a growth market, doesn't possess technological risk. And because it's federally illegal, opportunities are available that I think are commensurate with far riskier industries relative to the actual risk in cannabis. So I wanted to deploy capital in cannabis, but I didn't want to be a single family office investor, passive and illiquid in this nascent frontier space. So I went to Dave and Brian and said, I think there's an opportunity to start an asset management firm focused on providing capital to the cannabis industry. I think it's important that we hire operators as well. Since this is a new space, there's a lot of mistakes to be made. And I wanted to be in a position where my team could provide the most value to not only assess opportunities, but to add value to partner companies. Peter Bio and Jonathan Goldrath were clients of Feuerstein Kulik, the law firm. And Pete and John have backgrounds similar to mine. Pete started his career after Chicago Business School in banking at Lazard, doing restructuring and M&A work, and then moved into principal trading on the credit side in about 2004, and spent the next 14 years at credit hedge funds, including Sandelman and Wingspan. Jonathan spent 10 years at Fortress, working for Peter Brigger and Dean DeColius on their Drawbridge fund. In 2017, Pete and John partnered up and put in an application for a grow process license in the first round of licenses in the state of Pennsylvania, where Pete was from. They won the license. They moved to rural Pennsylvania and built a 56,000-foot greenhouse and a commercial grow processor. They were the second operation up and running in the state. Cresco, which is a large publicly traded multi-state operator, beat them by a couple of weeks. They then won a processing license in Ohio. Jonathan moved from Pennsylvania to Ohio to build a processor. They then won a license to dispense cannabis in Pennsylvania's second round. So they opened up the dispensary in 2018. And then when things were really frothy in the cannabis market, they decided to sell their assets. So they exited in a two-stage transaction to two publicly traded MSOs. They exited their cannabis holdings in 2019. The market quickly fell apart, and Pete and John returned to their roots as credit investors and acted as lead investor, underwriter, agent, and syndicator of 3 loans totaling $55 million. So I met Pete and John in November of 2019, convinced them of the merits of pooling our talent, our capital, and resources. We'd each worked at institutional asset managers. I ran one for 16 years. Pete and John worked at well-respected institutions and then had the cannabis experience. And we decided to pool our talent and resources and create FocusGrowth. So that was year-end 2019. We started working together as a team in early 2020. COVID hit, as you know. We did our first couple of deals in the first half of 2020 pre-fund. I kept those deals in an SPV in preparation for raising our first fund. We had our first close on our first fund, FGCP1, in August of 2020. It was at $52 million. Important to note, the team at FocusGrowth was 20 million of this 52 million. We had subsequent closes, with the final close in April of 2021 at $163 million. We continued to invest Fund 1 through May, June, July, into August, had the final capital call for Fund 1 in September of 2021. We made our first distribution on Fund 1 in January of 2022, and that distribution was 17.5% of committed capital. We'll make our second distribution on Thursday this week, and that'll be about 4.5% of committed capital. Our plan is to continue to distribute capital every quarter. As you'll see in a moment, the portfolio has a very high cash yield. Once we're fully invested, we'll be distributing interest every quarter. For Fund 1, the interest will be at least 3% every quarter, and that'll be augmented by amortization payments and repayment of certain loans. We launched Fund 2, FGCP2, in September of 2021, and we've had 2 closes and funded 3 deals in FGCP2. The fund has 75 million of committed capital. We have another close later this month, and we funded $50 million of deals. Just a comment, here's the portfolio from Fund 1. And you know, what you can see, our approach is really focused on senior secured loans, providing debt to companies. It's non-dilutive. We want to help companies grow. We're not interested in ancillary businesses. We are focused on plant touching, license holding, operationally intensive, legal or regulatory complex situations. We like companies that have existing operations where we can really vet the talent and caliber of the management team, and we're looking to bring in non-dilutive capital to help the companies scale and grow. And I'll just walk you through one of our transactions. The first transaction we did was Private Company A, and we funded this company in March of 2020. The company was a single state operator that had about 9,000 feet of cultivation canopy in Illinois, and they had 2 operating dispensaries in the state of Illinois. The company had done 4.6 million in EBITDA in 2019, and they wanted $10 million to increase their canopy from 10,000 square feet to 30,000 square feet, and to open 2 new dispensaries for which they were already awarded licenses. Key thing to remember is in 2020, Illinois converted from a medical market to a rec market. So we funded them in March of 2020, pre-COVID. The company opened up 2 new dispensaries. They increased their cultivation. The market in Illinois grew rapidly, and the company went from 4.6 million in EBITDA in 2019 to 23 million in EBITDA in 2020. The company sourced an acquisition in Michigan for which they financed the equity themselves. We worked with them to source and negotiate and secure an acquisition in Arizona. We took out our original facility and gave the company $58 million to continue to invest in Illinois and to complete and invest in this acquisition in Arizona. And that was in the summer of 21. And just recently, in February of 22, the company had come back to us. We helped them with acquisitions in 2 other states, in Ohio and Missouri. They were providing the equity portion of the acquisitions. We took out our $58 million facility, put in place a $100 million facility, and we have an accordion for this company as well. So, you know, we're not looking to do 30, 40, 50 deals. We're looking for that small percentage of companies that are run by experienced management teams that have the equity capital as well as industrial expertise to grow their businesses. And, you know, you can see our loans have a similar flavor. They're all comparable in the sense that they have an interest rate somewhere in the mid-teens, you know, 13, 14%. OID, which stands for original issued discount. And what this means in the case of a loan, let's just say that we're going to give you $10 million, but it's a 10-point OID. That means the face amount of the loan is actually $11.1 million. So we'll fund you 10 million, but you have to repay 11.1 million, and the interest rate that you're paying, that 12, 13, 14, 15% is based on a face amount of 11.1. So this is a way for us also to increase the returns, but to help manage risk. Our loans are typically 3 or 4 year loans. And you'll see here, this is a 4-year loan with a 13.5% interest rate, 8.0 OID. NC1 means it's non-call one. So the loan isn't callable within the first year. This loan is callable in the second year at 105% of par, the third year at 103, and par in the fourth year. And that's what we typically find in our loans. We'll have non-call one or non-call two, some call protection, an opportunity for the company to repay the loan before maturity, and it'll mature at par. The other thing I'll say is we often tranche our loans. So there's been situations when we've underwritten a company and deemed their CapEx plans and the asset value worthy of a $15 million loan, but we may finance or fund the first tranche of $3 million day one, allow the company to deploy that. It lets us assess the success of deploying capital, whether it's in an acquisition or increasing their physical plant with new processing, opening up new dispensaries, or increasing cultivation. And it lets the company be more prudent in terms of investing the capital and not paying interest on the capital that they have not yet invested. So it's a bit of a win-win. We take the security package of the entire company day one, and then we get to see more information before we release more funds, and the company gets the benefit of not paying interest on funds that they're not investing today. In terms of security and collateral, again, typical structure is we'll have a guarantee from the parent. When there's owned real estate, we'll have a mortgage on the owned real estate. We'll have perfected security interest, liens across all the other tangible and intangible assets. We'll have a pledge of the subs that control the licenses, and we have deposit account control agreements. We're always thinking that this loan may default, and then trying to work backwards from that point to secure our collateral and prevent any leakage from that collateral. And the last thing we stress is, we're not loan to own. Our goal is to provide capital to growing enterprises. When companies are trying to get to know us before agreeing to do a deal with us, we make available the CEOs and CFOs of our portfolio companies so they can really start to understand what kind of partners we are.
So,
Arthur, I had a question. Yep.
Yeah, just it's not in the spirit of giving tax advice, but based on the last fund, for example, what's the K1 look like for capital gains versus ordinary income?
Yeah, sure. The K1 for last year, of course, it's early in the fund life, right? It was 100% ordinary income. When you think of any credit product, it is primarily ordinary income. We have an opportunity to get capital gains in a couple of different ways. So if a loan is at least 12 months in duration, when it's repaid, hold on a second, that's page 7. When it's repaid, usually this OID is amortized straight line, and that's ordinary income. When it's repaid, the premium on the OID, as well as the call protection, oftentimes we can make a credible argument that that is a capital gain. So the interest earned during the time period is ordinary income, but the acceleration of the original issue discount, as well as a premium for call protection, can be capitalized as long-term gains. And the second thing is, in a couple of our loans in Fund 1, we have warrants. One is this public company A, as well as a loan we just exited, private company H, where we have warrants, and the warrants will be long-term capital gains as well. But I would guide, again, I can't really give tax advice. Everyone's in a different situation, but like most credit funds, this is taxed as ordinary income. So
it sounded like in that example of private company A and perhaps all the others, not only are you in first position, but you're cross-collateralized with the subs and licenses and all that?
Yeah, that's a great question. In all of these companies, we're the only debt. And I think, we understand these businesses really well, and we do want to be can-do partners. We want to help companies maximize value. If I'm doing an $18 million loan, and I should say, our typical LTVs are in the 20s or 30s, right? So let's just say it's an $18 million loan with 30% LTV. The assets are worth $50 million. Let's say they have old real estate and they have a loan, a mortgage from a bank for $4 million at 6%. If we think there's $50 million of collateral and it's best for the company to keep out a 6% loan for $4 million, we'll take a second, or we'll be pari. right? But like we have not done that, but our view is we're flexible. We can really look at value across the enterprise. Our documents, we typically get landlord waivers as well if there's leased property, so that if there's an event of default, we can step in and operate as if we own the businesses to protect our, to get our cash flow and maximize our value. But we have not done, going back to cross-collateralization, we have not done greenfield investments. And I think today, this is where some people would run into issues. We have a new fund, it's 2 years old. This industry is growing really rapidly. I think one could be in trouble of one of two things. One, if there's fraud. And I think given our history in the industry and our relationships throughout, and the fact that our partners are badged operators who have had assets in 5 states, as well as our affiliation with the law firm, I think we're in a good position to avoid the fraud. The second thing is if you've made loans to greenfield investments, a couple of people who might have some equity, want a license, they have a location, they're going to build cultivation and dispensary out on Cape Cod or somewhere in Maryland. If they don't have any cash flow today and you've given them a loan, and let's say that loan had 6, 7, or 8 months of PIK, you got to restructure that loan. Because right now there's been cost overruns and CapEx budget, there's budget overruns and CapEx delays. There's no way they're producing product. We finance greenfield of an existing operator expanding into states. So many times, we have one of our loans, it's an Ohio operator. They have assets operating, generating cash flow in Ohio, but they won licenses in 2 or 3 other states, and they'll infuse the equity. Our debt will come in to help them build out those states. That's great, because the risk is diminished because you're collateralized across the whole portfolio, and there's an existing operation with revenue and cash flows to support the debt today.
Is there any states, like any other lender, that you prefer not to operate in because it's difficult to foreclose? Or
it's an interesting question, and the answer is not because it's difficult to foreclose, but we do have our favorites. So I would say that, let me take a step back and talk about the market, and this gets into why do we like some of the states or not. This is a massive market, as I said earlier. It's estimated that the total market today is $100 billion, and you see the estimate for the market in 2021, $26 billion. Over time, that $100 billion is going to grow as you have new form factors and people gain more confidence and comfort with cannabis. Plus, when it's federally legal and dollars are going into testing the efficacy of THC and CBD products, I think there'll be bigger use cases. But in the meantime, that $100 billion total market versus $26 billion today, more states come online. More states convert from a medical market to a recreational market, and then the penetration grows. So what we typically see is a state will have a medical market, and something like 1.5% of the population goes and gets medical cards. And the data here is perfect, because if you go into, first you need a doctor's script if it's a medical market, but if you walk into a dispensary, they take a picture of your license and everything is tracked. So that grows 10, 20, 30% a month. 1 or 2 years later, 3 or 4% of the population is consuming cannabis. There's a ballot initiative or a referendum. The state passes adult use, and then plus or minus 10% of the population uses cannabis. And that grows such that in California or Colorado, you might have 18 or 25%, somewhere in that estimate, using cannabis. Still a far cry from beer and alcohol consumption, which is about 60% of this country. So in terms of mind share and perception, you got a long way to go.
A long way to go.
Now,
Super interesting data point, right? Tied into your license, how much weed you bought last year.
Well, yeah, of course. Yeah. And but the numbers, the analogs are pretty consistent about how much each person consumes, $80 each time on a recreational, 100 medical. But going back to your question about states, there's some states, limited license states, especially the ones that are medical only today, that we think over time, meaning the next 1, 2, 3 years, will go from medical to rec. Now, important to understand, we do not underwrite a change in status. So if we're going to give a company money and it's a medical only state, we do not assume it changes to rec to support our loan. But states like Pennsylvania, Ohio, Maryland, Missouri, Florida, right? These are states where they're limited license. So licenses have a lot of value. The price of cannabis is really high, and it's forecast to stay that high because new licenses are being issued. The population of consuming patients is growing, and there's some probability that they convert to adult use over time. So to answer your question, 2 states we have not done any deals in are Massachusetts and Michigan. And I think we had a variant perception here. You know, the price 2 years ago, the price of cannabis was $3,000 plus, $3,500 a pound wholesale in Michigan, over $3,000 in Massachusetts. And our view was these are not limited license states. So these super competitive, high prices would not sustain as more licenses were issued, activated, people got capital. And sure enough, I think the price today is about $1,200 or $1,400 in Michigan and about $2,200 in Massachusetts. I contrast that with mature states like Colorado and Oregon, where the price is $1,200, but the battle's been played. You know who the winners are. So I would rather lend money to a winner in a mature market like Colorado or Oregon, where I know that their brands, SOPs, scale, allow them to earn good margins, than make a bet in a volatile state where there's price pressure over time, Michigan or Massachusetts, where I don't know who the winners are. And the last thing I say, we've not done anything in California, and California continues to be plagued by a very robust illegal market. And
Yeah, I was going to ask that question. How much that impacted, right?
oh man, it's so bad. I mean, look, I think just like any market, you need the willingness and ability to police. And I think in California, because, you know, cannabis culture is so entrenched, you have an ocean on one side, you have Mexico to the south. It's very, very hard to police. The DEA or state officials can burn down farms in the Emerald Triangle and new farms appear. It's a massive state. And I think the ability to police is very low. I also think the willingness to police, given the fact that there's a belief across party lines that this will be federally illegal sometime in the future, and that there's been a lot of harm done in social equity programs trying to repay and try to help people who have been impacted negatively by cannabis. California is just a tough place. And what you saw in the last year is when the price of cannabis in state gets high, i.e. $1,700, $1,800, $1,900 per pound, supply comes out of the woodwork. And instead of leaving the state to go to Michigan or New York, it just comes out of the state and pricing collapsed to sub 500 in some cases. So
Wow.
California is a tough place to do business.
So the delta between black market and approved, using the wrong word, but you get my point, is a function of reacting to the prices getting too high in the dispensaries.
Yes. Getting too high in the dispensaries, meaning like any commodity, high price is a cure for high price.
Yeah.
Right. So with cannabis, and if the state of California, you're growing it, and whether it leaves the state or find its way inside the state, its availability. I look at New York and I'd say, this is an extreme example, but I'd say New York is a bit of a failed market, right? People weren't incented to grow enough cultivation to increase the capacity of cultivation because enough dispensary license weren't given. So if I'm a user in New York, a cannabis consumer, I can drive 20 minutes and pay $3,000 a pound wholesale, $6,000, a pound retail, or I can have it delivered to my door for $1,000, $1,200 retail. It's very tough for the legal market to take off.
Wow, it's not really relevant, but maybe it is. I read something recently in Gothamist that there's little boutiques opening up in East Village where you pay a membership fee and they give you the cannabis for free. So they're not selling it recreationally. They're just selling a membership fee. And that's, of course, that's just circumventing, form over substance type of stuff. But I thought it was pretty clever.
It's clever. In DC, you used to be able to have it, but not sell it. So it would be like gift with purchase. Like you would go into a store and you buy a mug, and the mug would be, like $40 because it came with an eighth of cannabis.
Right.
So again, like over time, I believe that, pricing will normalize over time. This will be a robust consumer market. All things being equal, most people would rather buy things legally They'd rather buy it safely. They'd rather have a tested product. They'd rather have access to all strains and form factors, right? Part of the growth in the cannabis market is the emergence of different form factors. Flower might still be 40% of the market, depending on which state you're in, but chocolates, gummies, tinctures, vape, like all these have been growing very, very rapidly. And I think they're just a function. We had what we call a vape gate in 2020 with illegal product causing deaths. I mean, all things being equal, I think people would rather buy products safely. So we're early days in the evolution of this market. This is the beauty with cannabis as a growth market. It's not like investing in a tech market 10 or 20 years ago where you think there might be a market at maturity. Here, we know there's a market. It's just an illegal gray market today, and it's going to move into the legal market over time.
Is it fair to ask whether there's a meaningful distinction between the quality of the bud, for example, that's in the illicit market as opposed to the non-illicit market?
It's interesting. Interesting question. I'm sure there is. And the one thing with cannabis, I'm newer to the cannabis industry, is there's just a hell of a lot of strains, and things impact everybody differently because it's all based on your internal endocannabinoid system. So it's not like you build a tolerance per se based on body weight, etc. So I'm sure there are very, very big differences. The reason I laugh is because as you meet cannabis companies, everybody has the best flower and everybody has the best grower, right? And they really believe it.
Yeah.
But we got to look through to, okay, that's great, but depending on which market you're in, let's take a look at the numbers. Let's understand your SOPs. Let's understand how repeatable and scalable your operations are.
So other than California, for example, how do you thwart the problem with illicit cannabis and deciding the credit worthiness of the investments that you make? Is it easy to wrestle to the ground?
No, it's not, right? We when we underwrite something, it's a multi-pronged approach. We definitely have an appreciation for the state, understanding the history of the program in the state, and every state is different, understanding what the current licensing looks like, what their plans are for issuing more licenses in terms of current licensees. Are they funded? Where are they in their development? And, we treat this like a commodity. And if you're making an equity bet, like the crystal ball is really cloudy over a 10-year period. Over a 3 or 4 year period, our crystal ball is pretty clear. We know what states have planned. We know where people are. We know what maximum capacity could be. We also know, because there's a lot of data on this, we know how states, based on population and density and penetration, and we can forecast demand really, really, really clearly. So we start with the state level, and then it's definitely bottoms up, trying to triangulate the value of the assets, multi-pronged. It's not a liquid market where licenses trade on an exchange, but if you're looking at any state over the trailing 6 or 12 months, licenses would have changed hands. Now, we also have a lot of data from our portfolio companies who are looking to grow and are acquisitive, and then we can always, model out our cash flows as well. So it's a multi-pronged approach to assessing the value and the credit worthiness of a company. Always when we're modeling out 3, 4, 5 years, 3 or 4 years for the life of the loan, really thinking about how much debt can the company support. And oftentimes the companies come to us and they said, we need $13 million. We've spent time with them and said, no, you don't need 13. You actually need 18 to get where you want to be, but we're not going to give you 18 because that's the wrong thing to do for the company. What we're willing to do is give you 12. You need to raise 6. We can help you, but this is what's best for the company. We do not want you to default. We want you to be successful.
Yeah, you don't want to make it hard for them to succeed, right? Yeah.
Right.
Is there anything you're doing or considering doing out of the U.S.?
No, I just saw that question. Thank you, Jerry.
Thank you, Jerry. Jerry's a friend.
The answer to that, no. I think we have our biggest edge here, right? We have a team that's operated here. We have cannabis insiders here. We have a law firm that's top 3 in the country, biggest on the East Coast that we're really close to, where we can kind of leverage resources. And it is federally legal, so banking activity doesn't find its way into the sector. So I think with all those, given our edge and the supply demand disparity, the greatest opportunities are in the US. Not to say other markets might not be interesting, but we think there's enough to do that we can deploy all our capital in the US for the best risk-adjusted returns.
Yeah, how much could you possibly do, right?
Yeah. I mean, look, again, these markets, we've looked at stuff. We spent a little bit of time, but not a lot. When you look north of the border, if companies can finance, in the single digits, it's not going to be that interesting for us, given our fund and our team's cost of capital.
Now, by the way, Jerry's a fellow Greek.
No, I know. I can see the name.
Yeah. Okay, I interrupted you a bunch. Continue.
No, it's okay. I'm happy. I don't know if there's any other questions in here, but
we're good for now.
Yeah. Okay, good. So we talked about the market. Let me go to sorry, 1 second. Let me try to share again. Apologize.
No problem. Take your time.
Yeah. Let's just go here to like our process in the fund. As I said, we're not a BDC, we're not a REIT. We have the most flexibility to deploy capital creatively and flexibly to help companies succeed and to give us the best risk-adjusted returns. The way it works, we have a investment committee, we have weekly meetings. People are in charge of developing relationships in different markets around the country and in sourcing opportunities. Might be 6, 12, 18 months ahead of time, but it's trying to meet that top couple of percent of companies that are run by management teams capable of creating real value. We'll start socializing an idea early stages amongst the team. A partner and another member of the investment team will probably sign an NDA and engage with the company in their data room. A lot of times companies are pre-institutional. They don't have data rooms. They don't have audited financials. We'll be in charge of at least requesting the information or piecing together historic information from bank accounts as well as QuickBooks. We'll get to an assessment of what the company needs. We'll come to investment committee and start socializing the idea about structure and price. We'll go back and forth with the company to negotiate a term sheet. Once we have an executed term sheet, we commence confirmatory due diligence and final documentation. I think that process is 45 to 60 days. I think, shorter than 45 days is kind of a stretch, right? Depending on the complexity of the operation. We then fund, we set up data rooms for the companies on an ongoing basis and are responsible for populating with data, whether it's bank accounts, KPIs from their stores, different harvest and testing results. And we do monthly calls with the companies as well. But in reality, we talk to our companies a lot more than once a month. As the example I went through, we're involved in some of the strategic decisions at the companies. They want to leverage our team. If a company's looking at expanding, they may bring us in to help us liaise with the general contractor or discuss which software and mechanicals they want to put in, HVACs and chillers for their indoor or for their greenhouse cultivation. But that's kind of our investment process. And Fund 1 had 14 loans to 12 companies, and we're at 3 loans already on Fund 2, but I expect the fund to be 10 to 15 positions. For Fund 1 and Fund 2, we said we expect the fund to be 85% senior secured, some hybrids and equity. In reality, Fund 1 was about 97% senior secured. I think the opportunities continue in Fund 2, FGCP2, to be mostly senior secured. And we're targeting mid to high teens net returns. Fund 2, the 3 deals we have in Fund 2 have a yield to maturity just over 17% and a yield to first call just over 24%. Our view is that most loans will not go to maturity. Either companies will continue to grow their enterprise value and EBITDA and cash flow. They'll grow their needs for capital as they expand within their given states or do acquisitions or grow de novo in new states. They'll come back to us for capital. Many of our portfolio companies already have come back to us. Or some companies will get acquired. And as they get acquired, larger companies may look to replace our debt with other debt. And then just lastly, a little bit about the fund structure. And, I ran a fund for 16 years. This is a frontier space. but I wanted to create something that was institutional in caliber here. So we have SS&C Technologies, our fund administrator, CoInvestment is our auditor. Our bank account is Dime. Lowenstein Sandler is our fund counsel. The fund structure, this is a 2-year investment period plus one potential 1-year extension. Our first fund was invested within that 2-year period. The harvest period, 4 years plus a 1-year extension. Our loans are 3 or 4-year loans. To the extent we've negotiated warrants or equity, those are typically 4 or 5 years in life. The management fee is 2% fee on committed capital. So it's a drawdown structure of a fund. Someone commits capital today. On each close, when we fund a new investment, there's a rebalancing of the portfolio such that upon final close, every investor has the exact same portfolio, their pro rata share at the same price. The only difference is there is an 8% annualized warehouse fee that later close investors pay on invested capital to earlier close investors for warehousing their investments for them. So it's a 2% management fee stepping down to 1.5% after we invest all the capital. And this is 2% on committed capital, and it's 1.5% on invested capital. So as we continue to return capital back to investors, the 1.5% is assessed on a smaller and smaller rate base. There's a 20% incentive fee, European style, and 100% catch up. So what this means is if you invest $1 million into the fund, we will draw it down over the course of 2 years. You will get distributions. You'll get your $1 million back, an annualized 8% return before we earn any profits. Then the next 160 basis points or 20% of that 8% will go to the manager. And then there's an 80-20 split, 80% to investors, 20% to us. As I mentioned, the team is the biggest investor in our funds. So we've committed to at least 10 million or 3% of fund 2. In fund 1, as I mentioned, we were 20 million of the 163 million. And then we'll offer co-investments to large investors in fund 1. We had a handful of investors greater than $10 million. We expect something similar in fund 2. So that is that's what I had prepared.
Is there friction on the co-investment?
For fund 1, for fund 2, it's 0 and 10. So if you're an investor in a fund, you can kind of buy down your fees, so to speak, and come into specific deals at 0 and 10.
Yeah, super cool. Well, what's a good LP look like to you?
It's one of the surprises was how difficult it is to raise money for cannabis. And, as I said, Hoplite was $4 billion. We had money from, University of Virginia, Notre Dame, Bowdoin College, the state of Maryland, state of Pennsylvania. None of those investors will look at cannabis. So there's no pension endowment foundations. It's family offices and individuals. So, most of our investors for Fund 1 is bifurcated. We had a lot of people like me, guys or gals who run hedge funds or private equity funds who would invest some, kind of $2 to $5 million amount. We had a couple large family offices, I'd say on the order of $5 to $10 billion family offices that have dedicated credit sleeves or credit businesses. And then we had a lot of high net worth investors who are affiliated with RIAs. So, it's tough to say what the ideal investor is. Our smallest investor was 250,000. Our biggest was outside of internal capital was 15 million.
Yeah. So that was one of the questions. What's on this fund? What's the minimum check?
Minimum is 250,000.
Yeah. What's your prognostication? And I'm not trying to put you in the corner, but what's the 6 months from now, things go off the rails and it gets federally legal.
Yep.
How do you predict it's going to affect you?
Why don't we start with what I think is a more likely?
Yeah. Let's do that.
Because look, the biggest risk, and it's not a risk to the embedded portfolio, it's a risk to the opportunity. And even that is there's stroke of pen risk, as we used to say in the old hedge fund business. Things change overnight. Even if that happens, suddenly it's federally legal. This is a complex patchwork of state laws. You have 38 states that have some market in place. Each of them has different seed to sale laws. Each of them have governors that care about tax dollars and care about jobs. So even if it's federally legal tonight, I think states will offend the Commerce Clause. You're not going to have a functioning market like beer and alcohol for a number of years. But let's take a step back. What do we expect? On 4/20, Schumer will put forth a bill for federal legalization. It'll fail. It'll let him point fingers to the Republicans, and then it might pave the way for safe banking. I don't know if safe banking passes the Senate this year. There's a shot it does, and then there's a comment period, and maybe it's enacted late in the year or early next year. I think safe banking is a step in the right direction in terms of opening up the market. However, it uses a Dodd-Frank definition of banking, which does not include the capital markets. So, people say cannabis is unbanked. The truth is, yes, at retail dispensaries, that's a cash business, but every cannabis company has a bank account. Now, they may pay a bank $1,000 to $5,000 a month for the privilege of having a bank account, but they have a bank account. So I think what safe banking will do is open a way for the use of credit cards at dispensaries. So you might move from, and it'll make it easier for these companies, instead of having a state chartered thrift or credit union, they can go to like bigger, more stable banks. So it's a positive for the industry. We've already seen banks lending in the space, but banks will lend against a real estate, and they'll lend against value that's like highest and best use outside of cannabis. So, we might have an example where a company has a cultivation facility where they've already pumped 10 or 15 million bucks of capex. They have a license for that facility. The facility might be worth 30 or 40 million dollars conservatively, and a bank will look at the facility and say, okay, if it's not cannabis, it's worth 4 million bucks. We're going to extend $2 million, in a mortgage. So maybe on a margin that'll start to change as well. But I think it definitely is crawl, walk, run. I don't think there's at least a path that I see to massive market reform and legalization, and it looks like beer and alcohol.
Whatever the case, it's going to be quite some time.
I think so. And the other benefit with a 3 or 4 year loan, right? The visibility is pretty good.
Yeah. So interesting. I hadn't heard the banks charging what arguably is a risk premium for an account. Is that just make them feel better? Because that risk premium is not going to really thwart any risk, right?
No, you know what it is? I think it's just like supply and demand. It's because they can. And that's gone away. It's gone. I shouldn't say it's gone away. It's definitely, there's been pressure on it because more banks have been like, well, this is a growing business and it's legal in our state. And I also think there's technology emerging on the back end that helps some of these smaller banks, credit unions, get comfort with the cannabis related businesses that they're, so again, the field is getting standardized a little bit. And 2 years ago, look, we had trouble finding a bank to open an account. There was a bank that wanted us to have a deposit in the 8 figures, like $10 million, and they're going to pay us AFR, 13 basis points, just for the privilege of having a bank account. So that's, so put it this way, I leave my long short equity business where the market's just fiercely competitive.
Yeah.
I start looking at cannabis companies, and people are like willing to pay 15 to 20% interest rates for senior secured. And it's because they can earn multiples on their money in the equity. And then, it starts to occur to me that this business, there's high perceived risk. I mean, I can't open a bank account. I mean, we have Dime, right? They're a real bank, but it was very hard to find one of the law firms I'd worked with in my long short equity days. Schulte Ross, Stewart and Kissel, Aiken Gump, Sidley Austin, none of them would come in to do docs for a cannabis fund. So then it became clearer to me why the opportunity exists. There's a big perceived risk, even though I believe the actual risk is not nearly as great.
Are you going to, do you suspect you'll be able to maintain the delta as interest rates increase?
So it's a great question. So it's twofold. First, we now started putting through on term sheets prime plus. We're looking at floating, right? Because we don't want to, I don't worry about rates getting away from us. I certainly don't worry about rates. So, TBD, but I think borrowers understand that, right? Because there's more interest rate volatility. When we started this endeavor early in 2020, I would say that a public company, there's a handful, 5 to 10 companies, Cresco, Trulieve, GTI, Columbia Care, Jushi, Harvest. They had public company debt outstanding, and the yield to maturity on that debt by and large was 12, 13, 14%. We were pricing, call it 19 to 21. Now, liquidity is just flooded into the markets, not just the sector. And a lot of those public companies, their debt traded to the plus or minus 8 or 9%. Our markets come in to 16, 17, I'd say 200 bips. And the reason is, sure, there's a ton of liquidity, but the liquidity is not finding the companies we're lending to.
Yeah.
And the liquidity is not willing or able to do the work we need to do to lend to those companies.
Yeah.
So it's one thing to write a $20 million check and be part of a $200 million Trulieve syndicated deal. It's another to find top tier company in Oregon or Colorado or Missouri. And, you know, they don't have audited financials. They don't have a data room. They're good operators, but that's a lot of work.
Yeah. 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 Especially if you're subject to, this is just an editorial, but if the banks get into the banking of this, you know, when's the last time you got a loan from a bank when you really needed it? You know, and the underwriting and, you know, the whole thing, right?
No, look, this is like the industry is not, it's not that competitive. There's a couple of mortgage REITs or sale leaseback players that don't really compete with us. We all know one another. But if you're operating a cannabis company and it's your family business and you won licenses and you're doing 8 million of EBITDA and you want money to grow and go from indoor to greenhouse, when you talk to our team, and there are people who have done it before in multiple states, I don't know, the extra 100 bips or 150 bips of total return doesn't mean as much as the confidence that A, the capital is going to be there from us, and B, you're going to have some people who know what they're doing, who can really help you, who want you to succeed.
Yeah. And let's just face it, being able to close is, you know, is a problem.
Yeah, no, the credibility, like the industry will institutionalize. I just think we're really early days.
Yeah, I think you're right. So what's the performance look like?
We've exited 3 loans and they've been in the 40s and 50s IRR. 2 have been refinancings. One was a company that was a large private company, meaning they'd raised money at $1 billion valuation, and the bond started trading and we traded them for like a 52 IRR. So we've only had 3 realizations. Everything is performing. You know, there's a J curve in a private equity fund structure where, you know, we're charging on committed capital. Now that money's deployed, we've started returning capital as well. I expect Fund 1 will be in the high teen net returns.
Yeah, great. Well, this has been super helpful. I respect the people's time. You want to wrap it up with the ask or whatever you want?
Look, I'd wrap it up first by saying thank you. Arthur, thanks to you and your team. Thanks for inviting everyone. Thanks people for making the time. I enjoyed the discussion. Thanks for the questions that you sent in as well. I think Arthur will make my information available. We'd be happy to engage one-on-one to share information from our data room, where we have a PPM that's probably worth a good read. You know, or I should say it's worth a read. There's 15 pages to talk about the team, the opportunity, the investment process, and the structure. And I'm happy to share that with you. And, you know, happy to, if you're in the city and want to do face-to-face meetings, which I so much enjoy, and I'm looking forward to getting back on the face-to-face conferences and meetings. But yeah, happy to engage with however you see fit.
That's great. I really, really enjoyed it, and super well done. I appreciate it very much.
Thanks so much, Arthur.
You're very welcome. And as I always say, thank you all for spending with us the only thing you can't make more of, and that's your time. Thank you. Till next time.
Thanks.
Thanks, John. Bye-bye.